So in financial terms that are used in project investment appraisal, project analysis, and cost control are what I'm going to analyze here. The first one is what we call the annual value, represented by as A or AV. So if you see A or AV, it represents annual value. And what is annual value? We said that annual value is a series of equal cash flows, most often savings in your application, that occurs evenly spaced over time. So for this course, we'll use end of the year accounting. There are two methods of accounting. There's end of the year accounting and beginning of the year accounting. In other words, the end of the year accounting simply means if I invest in January, by December, I'll go to my cash book and I'll know how much I have made. So in other words, the year starts January and
Uche, your line is breaking. So, I don't know if.
Okay, I think it's the network. I suspect the network. Can you hear me now? Please put me right.
Yeah, we breaks. Yeah, we can hear you. Okay. Why not put your screen on sharing mode? It's on the.
I'm sharing it. I think it's. Are you seeing my screen now?
I mean, presentation mode, slide mode.
Okay.
Sorry.
Okay. So the annual value is also known as annuity amount, or you also call it the annual worth. So it's either you call it the annual worth of an amount, or you call it the annuity, or you call it the annual value. Then the next one we have is what we call the present value. It says the value of a future amount in today's dollar. So if you are going to make an investment, or you're going to embark on a power project or energy project, the amount of money you are investing today is called the present value. So after taking into account all your analysis, the power, the generator, the solar PV, the inverters, and what have you, the personnel costs, the land, the fixed assets, and all the economic and project management terms, you will come up with a value, with an amount of money, and say, okay, this project is going to cost me, if I'm going to do it 3rd of June, if I'm going to start it 3rd of June, 2021, this project is going to cost me $20,000, it's going to cost me $10,000. That amount of money is called the present value. If you walk into a shop today, I want to purchase a car, the amount of car they'll ask you to buy that car is what we call the present value. If you want to rent an office and you are given a certain amount of money as the rent or the cost of renting that office, that is what we call the present value. But it's also called the present worth. This is the present worth, whether it's of a future amount or an annual amount or a fixed term. The third one is what we call the future value, represented with F or FV. And we say this is the value of a single deposit amount, or it could also be a series of amounts at some point in the future. It is also called the future worth. If you invest in a business or you invest in a project, power project, and consumers or clients are to pay you back certain amount of money, either monthly or yearly, that is meant to pay you a certain amount of money at the end of the year or at the end of investment period, that is the future amount. So if I invest money today and in 5 years' time, my shareholders or my equity is going to yield amount X in 5 years, that amount of money at that 5 years is what we call the future value. So let's say that the future value is at the extreme opposite end of the present value. So while the present value will talk about the amount of money in 2021, future value will be telling me the amount of money in 2026, if I'm talking about the 5-year project. So what is the worth of that money in 5 years? That is called the future value. The next one, the next financial term is what we call the life cycle costing. For those of us that have done MBA or have done some management course, who agree with me that this is one of the concepts of, this is the latest concept of project costing we have now. Because what the life cycle costing does is that it look into the overall cash flows, inflow and outflow of a project. It will include all the associated costs and savings. For instance, if I want to invest on a renewable energy project, the life cycle costing will take into account the initial cost of purchasing the battery, the PVs, the inverter, the chargers, and the other accessories. The life cycle costing will take into account the maintenance costs. The life cycle account will take into account the land leasing cost. The life cycle account, cycle analysis, will take into account the software purchases. The life cycle costing will take into account the security man that will even guiding the solar farm or the mini grid system. So life costing does not leave anything behind. It will take account all the processes throughout the lifespan of that project. So it's a better concept of analyzing project, not just in terms of the investment cost and the cash flow, but also the other operation and maintenance costs, maintenance cost, legal cost, and all other, even management reserve, even contingency reserves have to all be incorporated in life cycle costing, represented as LCC. The next economic term is what we call the net present value. Now, whenever you see net, it means it's the difference of something. So it says the difference between the present value of an investment, future's net cash flow, and the initial investment. So if I'm to invest 100 naira, 100,000 now, and the 100,000 will be giving me 10,000 every month, it means my future cash flow will be 10 times 12, which is 120,000. So the net present value will now be 120 minus 100. So whenever you see net means initial investment over the final cash inflow. But there's also some other thing we use the MPV for. If the MPV is 0, the project will equate to investing the same amount of dollar at the desired rate. So your MPV can come out as three different terms. It can either be positive, negative, or 0. So MPV, net present value, can be positive, it can be negative, it can be 0. When the MPV is positive, we say that that's a good investment. If you do analysis and the MPV is 0, is positive, like the one I just did now, 120 minus 100,000 will give you 20,000. 20,000 is positive, so it's a good investment. It means I have a net present value of 20,000 naira, which can be likened as profits. When the net present value is 0, it means the project is just breaking even. No profit, no gain. When the net present value is negative, that project is not worth investing. It's a bad project. It's a negative project. It means if I go ahead and to invest in this project, I'm going to long run at a loss. It means that the future cash inflow of that project cannot equate the present value of the investment. That is your NPV being negative. Then we have the next term, which is what we call internal rate of return. We say it is a discount rate at which the present value of a project equals the present value of the project savings. So the IIR is the interest rate at the point where the MPV is 0. So I want you to take this I want you to grab it very well. We say that MPV can be positive, it can be negative, it can be 0. When your MPV is 0, the interest rate that made your MPV to be 0 is technically referred to as internal rate of return. That is your internal rate of return. So internal rate of return of a project is that interest rate, is that hurdle rate, is that discount rate at which the project is neither making profits or is making gain. In the banking industry, that is like their baseline for their baseline interest or their hurdle rates. Or in a company, that is their what they call it investment rates. In fact, I was teaching some people earlier today. I told them that that every company has a rate at which it can loan money. If you're a businessman, you're an entrepreneur, you're an investment banker, or somebody who is into investment, there is a benchmark, there's a minimum baseline at which you benchmark your profitability in any project. Those of us who are into contracting, who do go for bidding, will agree with me that any contract that does not give you minimum of 30% profit is risky. And I was telling some people today that most foreign companies, when the profit is not up to 40, 50%, they're not going into it. So that could be likened as the rates. So some people also call it the minimum attractive rate of return, MARR, minimum attractive rate. So most times the IRR is an indication of how, it's an indication of what interest you should fix your own internal rate of return. Okay, like banks, some days, these days, if CBN gives them money at 11.5%, that's the updated MPP monetary policy, is 11.5%, except for special consideration for SMEs, which is a single digit interest. When banks collect 11.5% from CBN, they will now factor in their profits, their liabilities, salaries of workers, and just put a markup, let me use that word, and then they'll come to 18% or 20%. Okay, and then when the risk is higher, they can add more 2% to make it to 2%. That's what banks do. Okay, if you walk into any bank, if you're a new customer, they don't know who you are, they will lend you at a higher rate. But if you have been a customer like Dangote, like Inosin, like Airpeace, they can go as low as even 15% or 14%. In fact, some can even go to 13% because they are confident of your investment, knowing fully well that CBN is already giving them at 11.5%. So they have already 2%. But that would be if 2% can take care of their other overhead. So any questions so far? I think, okay, we still have more terms. Okay, the next term is the interest rate. We all know what this means, but then let me say this. It can come in different shades and sound. So whatever terms they use, you just have to understand that the interest rates can be used in different ways. If you are borrowing money,
Hello.
I think which is having some challenges.
No, I'm back. I'm back. Okay. I think when I log in back, the thing muted me. I've unmuted myself. So I'm back to the interest rate. I said that the interest rates, if you are borrowing money, you call it the financial rates. If you're investing money, you call it interest rates. And if you are just moving money from one investment to the other one, you call it the minimum attractive rate of return, which is MARR. So the emphasis here is that whatever term somebody uses, the interest rate I can come in different shades, depending on whether you're an engineer, you're a financial person, you're an accountant, or you're an investment banker. So most banks also call it the hurdle rate. So whether you see a hurdle rate, you see investment rate, you see finance rate, or you see discount rate, they all mean the same thing. they are all referring to the rate of inflation or the rate of deflation, depreciation of the money. By the way, our depreciation inflation rate in Nigeria is about 16% currently, and that is why no bank will want to lend you money below bank can set their rates.
Hello, Uche, I don't know what happened. Your line.
Sorry, I didn't get that.
Other factors come. The rate. Okay.
Uche,
What I'm saying is that there's a correlation.
Your line is okay.
Okay, I can see. Or I say that the inflation in a country, in the economy, has a correlation with the banking rates, interest rates, discount rates. Remember, all of them mean the same thing. So I say there's a direct correlation.
Uche, sorry to interrupt you. I was just wondering. I think it's also important, like some of those terms that you're using to refer to as interest, discount rate, module rate, and the rest of them. I'm thinking that it's also important you state that the circumstances in which they are being used. So when you're moving money to the future terms, in most cases they call it interest rate, and then when you're moving it backward, that's when you now begin to call it discount rate. Kind of. So I'm just thinking that it's important to throw more light in those aspects so that it becomes very clear. Can you hear me? Since we lost Uche. Can any other person hear me?
Yes,
yeah,
I can
hear you. I can hear you. I think Uche need to do something about his connection. It's really disturbing.
Exactly. Because the problem is from Engineer Uche.
Yeah, it's from his own end. I don't know. I'll try and see what he can do about that. But just as I was trying to see, he was trying to put different kind of definitions to the interest rate. And I had wanted him to also expatiate on the circumstances in which they are being used. So you're moving money from the present time to the future. In most cases, it's called interest rate. So from you want to find the future value of the money. But when you have a future money and you want to bring it down to the present value, so in those circumstances, it's called discount rate. So that's what I just wanted to call his attention to before his next question.
Okay, so thanks for that. How about hurdle rates then?
So hurdle rate, the hurdle rate is basically for maybe for a company, they can set a certain rate in which investment becomes attractive to them, so that I can say, okay, if somebody brings an investment, or if we need to do an investment in our own company, and the rate does not meet this, the interest rate this time does not meet their standard, their requirements.
Okay,
Then
Chichi, I'm
it's a
back.
no. Okay. So just let me land. I was just trying to expatiate on hurdle rate. Yeah. So if they had said that benchmark, that any investment that does not meet a certain requirement in terms of the interest rate, maybe 11%, maybe 15%, then it is not it's a no-go area for them. But the moment that investment has an interest rate above that 15%, then it has more like crossed the hurdle. Then they can weigh into that investment. I don't know if that's.
Oh, that's clear. Thank you very much.
Okay, Uche, okay. Please continue.
I think I've changed network. So I'm using the office network. So I've changed to my phone. I put my phone. So let me hope that it won't happen again. Okay, so thank you, Chima, for that explanation. I think the explanation Chima gave suffices. Hurdle rates, discount rates, banking rates, financial rates, borrowing rates is just the same thing. It's not for you to know how to derive it. In fact, if you're going to the bank to borrow money, they're going to give you rates. So if they give you their rates, you can now add you can do some small markup. Okay, you can add your profit in terms of percentage in form of interest also. So if I borrow from Stanbic IBTC, for instance, at 10%, because my friend works there. So if you have to borrow from me, I think I can say I will borrow you at 12%, okay, and then make 2%. So that's just by the way. So, hold on. Okay, we are back. So the next term is depreciation. Depreciation. You say is an amount of economic value that is used up during the accounting period. Depreciation is not a cash flow. It is for accounting purposes only. So depreciation is the loss in economic value of an investment, be it a project, be it a machinery, or be it something of value. Okay. As you said, it's not a cash flow. You don't say my depreciation is 5 naira or 2 naira. No, it's rather is a loss in economic value of an investment. Then the other one is the payback period. The payback period is simply the number of years needed to recover an initial investment. So everybody that's investing in a project, in a power project, or in a renewable energy project, your whole idea is to recover your investment. So how long it will take you to recover this investment is what we refer to as the payback period. We might not go into all that, but the payback, we have the simple payback period and we have the discounted payback period. Simply put, the discounted payback period takes into account the time value of money, while the simple payback period is just your saving, the cost of investment over the savings. So if I invest 20,000 naira and every year I'm going to recover 5,000, the payback period will be 20/5, which is 4 years. So it means in 4 years' time, I'll recover my money. If I invest 20,000 naira and in 2 years, and the project is going to save me, or the positive cash inflow is 10,000 naira per year. So it means that the payback period is 20/10. 20,000 over 10,000, over 10, sorry, over 10,000, and that will give me 2. So it means the payback period of that project is 2 years. Okay, he said that it is not accurate. The straight line payback period is not very accurate because it ignores the time value of money. So we now use what we call discounted payback period. And this is calculated after discounting the net cash flow using the minimum attractive rate of return. So you call it attractive or you call it acceptable. So the minimum acceptable interest for which I will accept to invest. The next economic term is what we call the salvage value. The salvage value. It says it's the value of the equipment at the end of the project life. Sometimes salvage value is positive. That means you can sell it. And sometimes it is negative. That means you are going to spend more money on it. Okay. Example of an asset that have a negative salvage value is nuclear waste. Okay, you know that nuclear waste, disposing of nuclear waste is a very difficult thing to do. Sometimes you need to pay poor countries to dispose it, or you pay some countries in the Sahara to go and dispose it because of the long-term radioactive implication of nuclear waste. Also, some machines that we use in our industries can also incur money when we want to dispose of them. So that's why salvage value can be negative, can be positive. But I know that most of the time, the salvage value can either be ignored or it will be positive. Okay, here he said that the salvage value is usually ignored in this section, but it does occur in a problem. Treat it as a future value. So admittedly, salvage value is ignored in most power projects because at the end of the lifespan, we feel that it will cost more to recover that project, or it will cost more to revamp that project. There's a certain level that just like our refineries in Nigeria now. Okay, for me, the amount of money we're putting into those refineries will build us new refineries. So the best thing to do is to scrap them, or sell them off, or to say you're going to do a turnaround maintenance again or revitalize them again. For me, I know it's not a good economic decision, but that's by the way. Okay, the next economic term, which is supposed to be number 10, I'm going to change it, is the life of the project. And every project has a life cycle. Every project has a lifespan. If it does not have one, you need to improvise one. You need to envisage one. okay, is more like a fixed boundary condition that at the end of 10 years, at the end of 5 years, this project is no longer going to be profitable, or this project is going to come to an end. That's why in some of these foreign countries, you see some buildings that they have built 60 years ago, especially in places like New York. After a while, you see them detonating this building, demolishing these buildings. Because when you look at it, you find out that these projects have already lived its usefulness. And the real estate investor or the owner must have made the money he wants. So the best thing he needs to do is to demolish it and then erect a new one and then start up a new economic life. So N represents the life of the project, the number of years that we will receive annual savings. And this is what we use in economic analysis. So the two indicators that I'd like us to pay credence to, which are always fixed, is the life cycle and the interest rate. The interest rate and the life cycle, take note of them. They are usually fixed. The salvage value, you can't predict it. The payback period, you don't know. Something might go wrong and it will increase. The depreciation, the property or the equipment might be well maintained, that the depreciation might be so minimal. Okay, the interest rate, again, you can't play with it. Then the other things, you can actually play with them. So any questions so far? Okay, if there's no question, then we'll move on. The next thing we're going to look into, talking about the concept of time value of money, is the terms we are going to be applying for our calculation. By the way, most of what we'll be doing today is calculation. So I'm just using this 1 hour to lay the foundation. So just be patient with me. Okay, very soon we're going to, because when we say cost has to do calculation. So we're going to do a lot of calculations. Okay, now there are 5 variables in every economic financial indices. There are 5 variables you have to look for, you have to compute for, or you have to understand. The first one is P, represented as P, and that is the present worth, and is the amount of money at the present time. The second one is the future worth, and the future worth is the amount of time at the present. Is the future worth is the amount of money at some future time. And the next one is A. The A is a series of consecutive equal end of period amount of money. Okay. Now, when we talk about A, let me put it in perspective, in proper perspective. Your A is the amount of a series of consecutive money. It could be equal. It could also come at the end of the year or the end of the investment period. So the amount can come at the end of the month. It can come at the end of the year. It can also come at the end of the investment. So if you invest in, let's say you have a car business, maybe it's a car business, the Uber business people do, or the bike business. Every day they will bring in returns for you, depending on the arrangement. It could be every day, it could be every week, it could be every month. But I know that most times our investment bring back return in terms of monthly, except for big investments, whereby at the end of the year, you call shareholders meeting and you hold meeting with shareholders. Okay, even if the money is bringing returns in every day, it is easy to aggregate it into monthly payments. So those payments that are coming as a result of your investment, it is what we call the amount. Okay, it could be amount going out, it could be amount coming in. If I buy a laptop now for 200,000, and every year I need to procure a license of 10,000. So it means that the amount of money I spend every year on this laptop is 10,000. If I also have to buy antivirus every year for it, and that antivirus costs 5,000 per year, it means that the amount of money I'm spending on this laptop to maintain it is now 15,000. Is now 15,000 per year. If I now use this laptop to do business, and this laptop yields 20,000 for me every year, that is also an A. It's also the amount. But in this case, is a cash inflow. And it will have a positive value. Why the software and the antivirus money, which is what 10 plus 5, 15,000, is a cash outflow. So at the end of the day, my net amount, my net income will now be 20 minus 15, which means 5,000 is what I make every year. So I just want us to understand the idea. So the F is a lump sum in the future. The P is a lump sum in the present. Okay, it is the worth of the P is the worth of the investment now, today. The F is the worth of the investment in the future. If I build this factory with 100,000, in 5 years' time, it's either the factory is worth 200,000 or the factory is worth 50,000. So it's either it appreciates by 100% or it depreciates by 100%. Any question? The next one is what we call, the next indices is what we call the N, the interest period, represented by N. The next one is the N, sorry, the number of interest period. Okay, most times the number of years the project will last is the N. And the next one is we have the interest rate, okay, which is represented by I. We have discussed extensively on how the interest rates can either be hurdle rate, discount rate, financial rate, inflation rate, and what have you. So he said the most common engineering economy problem involve the use of N and I, and at least 2 of the remaining 3 terms. So what here is telling you is that the fixed boundary or the fixed boundary conditions are usually the number of years the project will last, or if you don't want to use the number of years, you also use the number of payment period and the interest rates. So these 2 variables are easy to fix. So if I want to get money for my investment, I can walk into any bank today. And when I get there, I'll ask them, I want to borrow money. What is your interest rate? Or I'll go to my, how do I call it? My, in our place, we call it Umonna. Okay, I'll go to my meeting people, my Brethren Society of Nigeria, and tell them I want to, cooperative, that's the right word. I'll go to cooperative, to my cooperative, engineering cooperative, and said they should loan me money. At what interest? So those ones are fixed. So the next thing is that if I'm doing an investment and they tell me that I'm going to pay them back in 2 years' time, so whether the project will last for 2 years or will last for 5 years, my N will be 2, because in 2 years' time I'm going to pay back that money. So if I didn't use the N, if they didn't give me number of years, then it means I have to use the lifespan of that project as my N. So it means I'll be giving the bank equal series of payment every year. And God knows when I have to pay up the money, until I pay up the money anyway. So once again, these 5 terms is something we must take cognizance of. The F, the P, the F, the A, the N, and the I. Please take note of them. They are very, very important. So every economic energy cost problem, be it project, be it energy, be it power, will involve these 5. Okay, then you will now be given 2 to find one of them. Sometimes they can be given the 3, but then you only need to find 1, giving 1. So these first 3, one of them must be given to you. It's either you are giving the present worth of the investment, or you are giving the future worth, or you are giving the annual series of money that will be coming. So one of them must be given to you. So my task or my job this afternoon is to help you to understand which is which. Because once you understand which is which, the problem is half solved. You'll be able to deconstruct whatever terms they are bringing. So now, cash flow. let me just, before I go into the calculation, have I exhausted 1 hour? Okay, I'll soon be 1 hour. Then plus the few minutes we spent. Okay, so now the cash flow. A cash flow diagram is a diagram depicting the cash flow of a project over the life of the project. And it can be helpful in some energy management projects to ensure all of the cash flows have been accounted for. So here, this is a typical cash flow diagram. P represents the present cash flow, which may be negative. If it's pointing up, it's negative. It's positive. It's pointing down, it's negative. Then A represents the annual cash flow. It can also be negative. It can also be positive. It starts at the end of year 1 and continues through the life of the project. Then F represents the future cash flow. It can also be negative, it can be positive, but it occurs at the end of some future years, which is usually the end of the project. So a typical example, for instance, is what is the present value of 10,000 received 5 years in the future? So if you are going to give me 10,000 naira in the future, what is the value of that money at present? Of course, the value of that money at the present must be lower than 10,000. So every year, the money will lose value based on the banking rates. Hold on, excuse me, please. Okay. So the discount rate here is 10%. Good. I moved it. So the discount rate here is 10%. So if 10%, if I discount 10% from this 10,000 in 5 years' time, after 4 years, 10,000 becomes 9,091 naira. If I discount another 10%, it will come to 8,264. If I discount another 10%, it will come to 7,513. If I discount another 10%, it will come to 6,830. If I discount another 10%, I will come to 6,020. So you see that giving me 10,000 in 5 years' time and giving me 6,200 naira today are exactly the same thing. They are exactly the same thing. So let's continue. Okay, now, so we are getting close to the calculation now. We're getting close to the calculation. Just be patient with me. Now, using manual method and what we have been taught in school, engineering economy, engine 401 or 402, I can't remember what engine it is. You remember these formulas. But today, we're going to make it look very simple and very easy. We're not going to apply this formula, rather we're going to use interest tables. So it's a single payment compound factor. When we say the single payment compound factor, represented by SPCAF, single payment compound factor, is given, like the factor is given as this. We say a mathematical formula is developed to determine the equivalent amount of money, F, that is accumulated after n years from a single investment P, when an interest rate N is compounded 1 time per year. So if I have 1 naira today, what will be the 1 naira in future? All I need to do is to multiply 1 naira by a factor. And taking into account the discount rates and over a period of 1 year. And that factor is represented as this. So whenever you see this F over P, I in percentage, comma N, what it means is that I'm looking for the F. Please take note. Just take note, please. Whenever you see this factor, if I ask you to go to the interest table and read out this factor, have at the back of your mind that what you are looking for is the F. So it is to find the future value of a given present value. N year, after n years, and interest rate per year. And in mathematical formula, it's represented as this: F equal to P into I plus 1 plus I raised to power n. And this factor is called the compound factor. The second one is called the single payment present worth. In this case, you are looking for P and you are given F. You are looking for P. P is the subject of the formula and you are given F. And the mathematical formula is represented as P in equals to F brackets open this. Okay, that is the mathematical formula. So what I want us to take care in this class is that when you see a factor like this, know that the P is what you are looking for to find the present value of a future given value. So whatever that is up here is what you are looking for. And whatever that is down is what you are given. Then the I is the interest rate and the N is the number of years. The third one is called, now let me say this, in most of the problems you've been encountering, you might not necessarily need 5, there are 5 of them are thereabouts. You might not need 5 of them. You just want, I'll just show you a few ones that are always recurring. But then tomorrow you might not be doing economic energy costing. You might be doing something on project management or something on investment. Some of them will come handy, become handy. So it's good that we know, have an overview of all of them. So in this case now, you are looking for P and you are given A. So we are looking for the present worth of an investment given the equivalent uniform annual amount. If somebody that's owing me money, I've decided to be paying me the money 1 million every year for 5 years. What is the equivalent amount of money if he is to give it to me today and once? If I decide to give me all the money I want today and giving me bit by bit, which one is more profitable and which one is better? Or what is the equivalent of the single amount today translate to future equal payments? And this is the formula. Don't worry about this formula. Just know this one. Next is what we call the capital recovery factor. The capital recovery factor, in this case, you are looking for the A. You are trying to find the annual amount given the P. In other words, I know the amount this business will be generating, or this investment in power or energy will be saving for me. Okay, but how long will it take? Or what is the present worth of that money? So this is the formula, but I just want you to take note of this. The next one is called the sinking fund. In the case of the sinking fund, we have the A and we are looking for the F. In other words, we have the, and we know we are looking for the A and we are giving the future amount. The future amount. Okay, let me demonstrate this now. My son wants to study in the United States. And by the time he will finish his bachelor's in US, he must have spent $100,000. How much am I supposed to be putting in the bank every month for him to be able to spend to sustain himself in the university? That is what we call sinking fund. Some of us know about fund sinking. When you talk about sunk fund in cost, sunk fund is like forgone cost. It's like amount of money you put aside to meet a future need. Any amount of money you put aside to meet a future need is called a sinking fund. So you're just sinking money. Somebody will say, I'm building this house. I've been sinking money. Okay? Because you want your house to come out fine. And so on and so forth. So look at the long formula for sinking fund, but you don't need to cram all this formula. Just know that you are given A, you have to find F. Then the last one is uniform series compound form factor. In this case, I'm looking for the future amount and I'm looking for the future value while I'm giving the annual value. So somebody's going to pay me 10,000 every year in the next 5 years. So in 2026, what is the value of that money? after 5 years. You can say, a layman will say it's 50,000. No, it's not. It will be more than 50,000 because the time value of money comes in. So if you want to pay me 50,000 naira today, and you want to pay me 50,000 naira in 2 years' time, I prefer you pay me that money now. Because in 2 years' time, by the time you do your uniform series compound amount, okay, you will find out that that amount of money will be way bigger than 60,000 naira because of time value of money. So we're very close now. So these terms, as I said before, this is the factor term. This is the factor term. The factor comes in this way. So your P, anything that is in front is what I want to know. Anything that is behind is what I am giving. For instance, if I put A here, it means that I want to find P. I'm giving A, and then I and N are known. I and N are known. Okay. Find P given A. That is what this P means. So if I ask you to go to the table to get the value, you will know that you are looking for P and A has been given. And of course, I and N are already there by default. So in a tabular form, this is what it looks like. In a tabular form, this is the notation. The first one, I'm to find F, I'm given P. I'm to find F, I'm given P. This is the notation. This is the formula. This is the mathematical expression. The second one, I'm looking for P, I'm giving F. Okay, it is called the present worth payments. The other one is the uniform series worth payments. I'm giving A, I'm looking for P and I'm giving A. So if you want to solve it, all you need to do is to multiply your A by the factor. So this thing you see here is a factor that we can bring out from the table. This is, if you want to find the present value, present worth, multiply the future worth by a certain factor. Multiply the future value by a certain worth, by the future amount by a certain ratio or factor. Then the capital recovery factor, CRF. The capital recovery factor is the CRF. Okay, and what is CRF? The capital recovery factor means I want to know the small amount of money I will get every year, given the from the initial investments. I want to recover. This is the capital investments, and I want to recover the money through series of small payments. The sinking fund is I'm looking for the amount of A I will invest in order to realize a future amount. Then finally, the uniform series is I want to find the future amount given the equal series. I want to find the future amount of some cash flow that are coming into my account. So what you just said now, they are all represented as this. Okay. For instance, if the present worth of P is 100,000 and the interest rate is 15% and the period is 5 years, we calculate the variables with Excel as follows. Okay, that will be on Saturday, the last day of the training. We do that. Okay, we do that on the last day. So for the future payments, this is what it is. So for 5 years at 15%, this 100,000 will become 200,000 after 5 years, and that is the future payments. For the present payments, it will be 100,000, which is simply multiply the present worth by the future amount. So let us not get us confused. We can read up. You can go through this together. Well, we can go through it before I will understand it. But what this thing is just showing us is that this thing is like a loop. If you move money from now to 5 years time, and you move it back from 5 years time to now, it is the same thing. If you split it into amount, what series of amounts will you be giving me every year for me to realize this 100,000? It means 29,000 every year. So it's either you give me 100,000 now, or you give me 29,000 every year, or you give me 200,000 in 5 years. They are all the same thing. Any question? Giving me 100,000 now, giving me 29,000 every year for 5 years, and giving me 200,000 after 5 years. They are technically the same thing. They have the same value. They are the same. So it's left for you on how you want to give me. Either you want to give me 29,000 every year for 5 years, or you give me 200,000 now.
Hello, Engineer, are you still there?
Yes.
Or
Yes, I'm there. Hello.
Okay. Yeah, I can hear you,
Hello.
sir.
Can you hear
I
me?
hear you, sir. Yes.
You can hear me? Okay, it's okay. It's okay. I'm here.
Engineer,
So-
we lost it for a moment. So.
Okay. Okay. Now we're
Yeah.
going to start. We're going to start a calculation. So I'm going to observe. I would like us to observe 15 minutes break. Please, I would like you to do me a favor. Within that 15 minutes, get a calculator around you. You all agree with me that this is an online training. Online training. One thing I have seen in online training that it requires a lot of discipline. That discipline will come in form of where you are now. If you're in your room, good. If you're in your office, good. But if you're where your children are, then you're not going to enjoy the training. Then if you're on a table, better. I'd like you to get some paper. We're going to go into calculation now. So if you have a calculator, I'm going to give you 10 minutes. Sorry. 10 minutes. And this is okay. This is our break. This is almost half of the class. So I'll give you 10-15 minutes. I'm going to send you an interest table now. Now, the interest table is going to save you the calculation of calculating those I raised to power I plus 1 plus n plus this. You know, if you remember in those days in university, we all did it. But now we are no more in the university, we are working class, we are adults. So we are no need for those things. Besides, any exam you are writing, any professional certification exam you are writing, whether you are writing certified energy auditor, you are writing certified energy manager, you are writing certified energy cost, you are writing PMP, they will allow you to use interest table. Then if you are doing design in your office, or you are doing calculation in your office, of course, nobody will deny you that. So the interest table is a very important tool. So now, those of you that have the link, should go to that link I sent you. I'm going to upload that. Okay, since you're watching my screen, I'm going to go to my Google Drive now and upload it. Good. So this is the course material. So I open the course material. All of you already have these three. The Excel sheet, the webinar 7 that Nachima will take us tomorrow, and webinar 8 that I'm taking us today. By the way, webinar 1 to webinar 6 are the previous training we have done. Somebody messaged me today that I should send them some previous ones. I can't remember the person, but I don't know if I've done that. So let me quickly upload the interest table. Please download the interest table now and open it. Okay, find somewhere very important and open it. Okay, so it's uploading. And after uploading, I will also share. Okay, I can even upload it or share the link on our chat box. So I want everyone to go to our chat box now. Okay. And download it. Hold on. Interest table. Just hold on, please. Okay, there we go.
Hello.
Yes, sir. Can you hear you, sir?
Hello. Yeah, this table is not among the material you sent to us earlier.
Is not, but I have uploaded it now. Yeah, it's not. Let me just tell you this: the material can be downloaded online anytime. There are many of, in fact, there are millions of them online. It's just like a figure of table. What was that table we used during during secondary school? Yeah, and it's allowed in, quote me anywhere. It's allowed in any exam.
All right.
The interest table. The difference is that when you go online,
Hello. Hello.
I think Engineer Uche seems to be having some network glitches. Engineer Uche, are you back?
I'm there. I'm here.
Okay. We lost it for a moment, but welcome back.
I don't expect us to. I expect this network to have. I don't know why the network is still giving problem, but I've changed to MTN now. I was formerly using the office, the intranet we have at the office. So I don't know why. Okay, let's continue. Well, let's continue. So please, gentlemen, let me just wait until we open the interest table. So have we opened it?
Still downloading, Uche.
Okay, I'll be patient then. Let me also try to. And it's already on the Google link also. You know, most of our materials are on the Google link. So you can go there anytime to. So this is what the interest table looks like. This before we go for a break. So the interest table, we're going for 10 minutes break. So the interest table is like this. Are we all together? Let me explain the interest table before we go for break. Our going for break is for you to go and get your calculator, get your writing materials, and make it look as if we're in a class. You know, as much as I can't see you, you can say not to do any of the work, but just put in your mentality and just imagine me being in your front as a teacher or as a policeman. Okay. So now, if the interest table comes in different interests. Now, this one is 1/4% interest. So each page represents a particular interest. Each page represents a particular interest. For instance, if I go to page 4, that is for 1% interest. The next one is for 1.25% interest. The next one is 1.25. The other one is 1.5% interest. The other one is 1% interest. The other one is 2% interest. This is how you see it until you get to 50% interest. So this is one of the biggest interest table I download online. Now let me shock you. Just to prove to you that there are many versions you can see online, but this is the most comprehensive one. It's free. I got it online. It's no big deal. So this is Google. So if I go to Google now, I'll say interest table. Just go and imagine what to come up. So if I want to make it big, if I say interest table, okay, I just press enter. Gentlemen, I have millions of them. Can you see something?
Yeah.
There are thousands of them, so you can download anyone. This is really like
are they the same?
They are the same, sir. They are the same universal. It's a universal document, sir. Absolutely the same. Because this one I'm giving you now is 32 pages, and there are some that will just capture the key interests. In your exam, if you're writing any of the exam, if you're writing the certified energy auditor exam, they will just choose 5, 10, 15, 20%. Those key interest, sometimes 12%. Okay, look at this one. Look at this interest table. It's the same. So you can see thousands of them. This one is from an American company, whatever. Okay, and so on and so forth. So that's by the way. So I'm seeing this one looks beautiful. So that's by the way. So let's continue. So this interest table, why this one is so unique, Seth, is that it also teaches you how to use it. It makes it so simple for you. So on the column, on the first column is the number of payment periods or number of years. Number of payment period or the number of years. So if I'm giving 1 year and the payment is once per year, it means that the number of payment period and number of years are the same. I want you to understand this now. The payment period can be different from the number of years. But if the payment period is end of every year, technically means that the NN represent the end of payment period and also represent the end of the year. So if payment is made monthly, then this N also represents monthly. So if you're working on a project that has monthly payments, it means this is 1 month, 2nd month, 3rd month, 4th month, 5th month, 6th month, provided that payment is made at the end of every month. So this N now represents end of period. But fortunately, most energy investments or most investments are annuitized. They are annuitized. In other words, they are evaluated on a yearly basis. So in that case, your N is also your number of years. Is that understood? Then, under here, if you are doing MBA or you're doing some of these advanced courses, management courses, they do in Harvard, they will be talking about compound amount, present worth, sinking fund. Your lecturer can ask you, find the sinking fund. Brother, he's just asking you to find the A given what F. The lecturer in Yale will tell you, after speaking grammar, he will ask you, what is the capital recovery factor? What he's asking you is, what is the, find the amount given the present what? Some other person will say compound amount factor, and so on and so forth. So these 3 terms, you just have to understand them, and they are the most widely used. Most times, these arithmetic gradients, you hardly use them. They never show up. They never show up. Put me anywhere. So our focus will be on these 6 here. And among these 6, as far as projects are concerned, they will always revolve around sinking fund. In other words, we want to buy a new transformer in our office in Abuja, and the company say they can deliver the transformer in 2 years. So how much are we going to be saving now to be able to purchase that transformer in 2 years? That is called a sinking fund. Or Siemens brought us a UPS now because of our power problem, and they say we should buy this UPS today, and that we should be paying them so amount of money for 10 years to pay up the amount for the UPS. That money is called capital recovery factor. In other words, that's the amount of money we'll be paying them based on a certain interest rate for them to recover their capital. So if you are given any problem, as I said, you will be given the N and the I. So your task now is to say, among F, A, and F, which one am I looking for? Okay, let me go back again. So your job is among these 5. Okay, among these factors now, which one am I looking for? Hold on. So among these now, so any question you are going to solve today, your job is to deconstruct and reconstruct it to know whether you're looking for P, you're looking for F, or you're looking for A. That is your job. Are we okay? Are you looking for P? Are you looking for the future amount? Are you looking for the present amount? Or are you looking for that equal series of payment, like somebody have taken mortgage loan, or you have taken mortgage loan? Every year you must pay a certain amount of money for you to own that house. You've not yet owned the house. The mortgage company says the house is worth 15 million, but that you can be paying them 60,000 every month. So your job is now to do your computation, and you, at the end of this course, some of you will do that on your own. You'll be able to calculate to know whether the company is cheating you or you are cheating them. Sorry, whether they are cheating you or they are taking money from you, especially after we do the Excel application. Especially after the Excel application. So now, back to the interest table. So for the interest table again, the A, so this is the you can see my screen, of course. This is the N. You can look whether to find okay. Now are we together?
Yes.
Okay. I guess we would like to observe a break. All of us, should we? So we can get our calculator, get our writing materials, and then we'll just start the calculation. Okay.
How long?
Uche, just one quick question. So
Okay.
why is this table called compound interest factors?
Because the interest will compound, is compounding.
Okay, so all the interests are compounding on annual basis.
Yeah, on annual basis, yes, or quarterly basis, or monthly basis, based on the payment period.
Right. Okay.
Most conventional is annually.
Oh.
And that's how mortgage industry, banking, that's how interest compound. You know, if it does not compound interest, if you borrow me 100 naira now, 100,000 today at 10%, after 5 years, you only get 10%, isn't it?
Yeah.
So the time value of money is not there. So it's not, nobody does that again, sir.
So you have to compound it.
Yeah, you have to compound it. So the one you are, and it's also good for both parties. If I pay you part of the principal, you shouldn't be charging me based on the capital again. You have to charge me based on the
balance of the capital.
The balance of the capital. And if I go and borrow more, sir, you won't be charging me on the initial borrow. It's the new borrow that I borrow. In quotes. Okay.
All right.
So let us take just 10 minutes, not more than 10 minutes.
All right.
Just 10 minutes. So ease yourself, refresh yourself, and then come prepared for the calculation. And also go to the interest table. Familiarize yourself with it. Thank you.
Okay, so we'll be back in 4:40, right? I think it's 4:40.
All right.
4:40 we'll be back.
Thank you.
Okay.
Thank you.
For 3 days. Today, tomorrow, and next tomorrow. It is a seminar we registered last month. They are having it in Abuja. So that last month. So we were supposed to like 2 weeks. So we run for 3 days. EM calculator. EM web. I wonder how we'll be calculating this one from me. Where I'm sitting. Young video. I'm a man, I'm in 434. 5. So he has taken today. Okay. Okay, laptop.
Hello, please, those who are talking.
Okay. So are we back? So let's go to the first question.
Sorry, Uche, there's a humming sound. I don't know if it's from my side.
I'll take care of it now. Okay. So the first question we have today, let's just take a look at it, because we're using question to demonstrate everything we're going to be talking about. So as the question comes in, we'll be solving them and be demonstrating, using them for demonstration purpose.
Can you please return your screen to slide mode so that it becomes clearer?
I'll do that. I'll do that shortly. So let's look at this. It's what is the MPV for a project with an annual savings of 15,000? Discount rates or interest rates or banking rates or the cost of capital or weighted cost is 20%. And the project will last for 10 years. It means after 10 years, the project will have almost zero or zero salvage value. And if you're lucky, you don't have negative. The project costs, the cost of the project is 58,000. In other words, the initial cost of investment is 58,000. So one thing I want us to do is to understand that, what I want us to understand is that they can use different terms. You can use different terms to represent the challenge or the cost challenge, but your job is to rephrase them in a way that you will understand and be able to, because the point is for you to be able to solve it, be able to, play out the economic indicators, bring out the economic parameters. So this is the annual savings. So that annual savings, that's 15,000, is the A, is the annual savings. This is the cash inflow. This is when you have done your energy auditing. Sorry for those who didn't come for the first two trainings. You can't go back there. This one you are focusing on cost. When you are finished doing your energy auditing, you estimated that the net savings in kilowatts per day, aggregated to per month, accumulated to per year, is going to save you 15,000 naira. So that is the savings. So that means the cost of installing this solar power or renewable energy power is going to save your bill by 15,000 every year. That's what it means. And the so-called inverter or the so-called renewable energy solar panel you are bringing is going to cost you 58,000. And the money you are going to use for this project is coming from Stanbic IBTC or UBA, and they don't joke with their money. They're going to give you at a rate of 20%, and you have 10 years to pay back, or you have 10 years, the project will outlive its usefulness. So the question now is this project profitable? And how do you know whether it's profitable? By you doing the net present value, understanding the net present, having the net present value. Of course, if it is positive, is worth investing. If it is zero, is a break-even project. Maybe it has also social or environmental importance, because it's not every project that you do must give you profit. Some of them can be environmentally advantageous or socially advantageous. Okay. So how do we solve this now? So in a graphical way, this is how you present it graphically. The present cost is 58,000 and it's saving you 15,000. So in other words, in this cash flow diagram, you can see that 15,000 is going up. Okay, it's going up 15,000. And the lifespan is 10 years. The discount rate is 20%. So I told us ab initio that when you see the word net, net means the subtraction of something. So the initial cost of the investment is 58,000, but we don't know what is the aggregate present value of this income. It will be saving us $15,000 every year. But what is the equivalent of that 15,000 today? This 15,000 naira is an annualized amount. It's a sequential payment. It's a constant annual equal payment coming every year, coming from energy saving. But what is the equivalent today? Because today we are meant to cough out 58,000 to buy the machine that will make it possible, or to build the solar power, or to build the components that will be saving us 15,000 every year. So for you to know whether that project is profitable is to scale it back to the present and see whether it will give you a positive MPV, a zero MPV, or a negative MPV. Depending on the value you get, you will not be able to determine whether it's a worthwhile project or not. Okay? So how are we going to solve it? So let me go to my screen. So let me bring in the screen. The whiteboard. So this is my whiteboard. So the cost of the project or investment costs we are given as 58,000. Okay, I want you to see that as P1. Okay, or a P that we just have somewhere. The next is that we have the annual savings is $15,000. The interest, this must be a project in Nigeria for it to have such a high interest. Interest rate is 20%. And the lifespan, or the business, whatever you call it, as in it's the business, I don't know how to explain it, but the business window is 10 years. That means by 10 years we should close the business. We should be done with the business. So this can also come in different form. So the formula for MPV is savings minus cost. Okay, which can be P2 minus P1. That is the formula for MPV. The cost of investment.
Engineer, I think it's also important that you put PV savings, that is present value of the savings, because the savings can also be in future, and sometimes it's given in future value, so it has to be brought to future present value. So it's important you put PV savings minus PV cost. Thank you. Did we lost you? Hello, Engineer Uche, are you still there?
Savings. I'm back. I'm back. Yeah.
Okay.
So do you take note of cognizance of what you just said? It's good I will put it this way. When we say, so that you don't get yourself confused about P1 and P2. Okay, when we say P, it must be in the savings must be in the present, and the cost must be in the present. You must equate things based on the same reference level. You don't bring a primary 6 student and a primary 4 student and ask them to write a WAEC and expect to get the same result. No, you must allow some of them to be at the primary, or at least some of them should attend the same preparatory course, in quotes, just speaking using real life scenario. So now our job is to bring in the P savings. So the P, the present value of the savings represented as P is what we're looking for. And from the formula we have, if you go back to the slide, okay, our slide says that we are given A to find P. So we are doing capital recovery. Are we together, gentlemen? We are doing capital recovery. We are doing capital recovery. Okay. So in doing capital recovery, we are doing capital recovery, which is this. This is what we're looking for. We are given P. No, we want to know the present worth. Sorry. They are all the same thing, just that they are interchanged. We are looking for this. Then in our formula, I said whatever that is up is what we are looking for. Whatever that is down is what we are given. So we'll now go to our interest table. If you go to our interest table, you will find out that we are looking for P given A. So this is the column we're going to be looking at. This is the column where the answer will fall, where we're going to look up for in our table. So all we need to do is to multiply these whole factors on the table, on the brackets, all the factors in these brackets. We'll look onto the table and find the equivalent factor at 20%, 10 years, because the payment is annually, and we will have a single factor for everything you see here on the inside brackets. So we'll now multiply everything inside brackets by the annual savings. It will give us the present worth of that savings. Are we together?
Yes.
Yeah, thank you. So in other words, this is what we are doing, what we're here now. We are to find P. The P of what? The P of those annual savings. We are given the savings itself, which is A. We are given the savings, which is A. And this is the formula to use. So in this formula, everything inside this parenthesis can be gotten from the table. So if you go to the table, you look on the uniform present worth, on the present worth, you find the value of this table based on the I, which is 20%, and the N, which is 10%. So let's go to our table now. So if I go to my table, let me finish the formula on the whiteboard. So the formula on the whiteboard, sorry. So the formula on the whiteboard will be, we're looking for P given A, and in brackets, we're looking for the factor of P over A, comma, I, comma, N, or small n, comma. This is the same as 15,000 in brackets, what is the factor of P over A at 20% at 10 years? So let us go to the table now and look at the table with the interest rates of 20%. And we look at the column of 10 years and get the equivalent factor. So we're going to look for this. Yes. Good. So back to, let's go to our interest table. So this is interest table. This is 4%. So we're going to look for what? Which one? 20%. So can you go down 20%. To 20%? Yes. Oh, this is 40.
20%, 10 years.
Good. Here we are.
That's 0.1615.
So we are looking for.
Okay.
We'll be on column number 6 because we are looking for the present worth of the annual savings to bring it back to the present state, because the investment of 58,000 I want to do it now also. So two of them must be on the same pedestal. So two of them must be on the same financial reference, whatever grammar you want to use. Okay. Now, for 10 years. Thank you, sir. I think somebody's already there. So it means 192. So the factor is 4.192.
Yeah.
Good. Now I'll go back to my whiteboard. So back to my whiteboard. The present value is now 15,000 multiplied by 4.192. And that will give us what? Somebody calculator. I said we should come with a calculator.
That's 62,880.
Okay, hold on. Thank you, sir. I appreciate it. So please, somebody should just be our calculator master.
62,880.
888. So, gentlemen, what does this show you? What it means is that the $15,000 that are coming every year is equivalent to 68,000 today. Remember that 15,000 is going to come for how many years? It's going to come for 10 years. So you see, the layman will say 15,000 times 10, 150. But you are wrong, because by the time the money will get to that 10 years, it will have depreciated. So the net value of that money now is this. Therefore, our MPV is going to be the savings
minus the cost.
The cost of capital, the savings of capital, and there's how the economics, the accountant economics, that's how they use the word. But for me as engineer, it's savings and cost. So the MPV automatically becomes 62,800 minus 58,000, which is the initial cost of investment. And that answer will be what?
4,880.
So the question, is it a good investment or not?
It is.
So good investment. So what this thing helps me now is that if there's another alternative, okay, let's say it's Engineer Chima that proposed this investment, and you've done your calculation and you got this, and then my company from Germany, of course, maybe my partners in Germany now come up with their own, this time around not solar, but they are coming with wind. And after doing the analysis, we are getting an MPV that's higher than this. Then you know that their own investment is. So when we do investment appraisal, this is the major tool we use for investment appraisal, the MPV. MPV because it helps to give you the present worth, because the decision you want to take is in the present. So you need to make that decision now. So you need to bring on all the economic terms to the present. So let's go to the new question, the second question. Any question?
Yeah, I have a question, Uche.
Go ahead, sir.
So I know you mentioned that in most cases the N are given, that's the lifespan. But for instance, let's bring it down. Let's say we want to establish a power plant. You have a mix of equipment there.
Yes.
And how would you determine the lifespan of the plant itself? So you can then, for instance, if we want to use this particular example you've used, so we know our initial capital, and then we know maybe a certain percentage that will come on an annual basis. So how would you determine that life of that plant?
Thank you, sir. There are many ways to determine the lifespan, but the first question I'll ask you is what type of projects? Is it a build, operate, transfer? Is it a BPP? Because in most projects we're having in Nigeria these days is build, operate, and transfer. So that automatically establishes the lifespan, sir.
Let's say it is PPA.
Okay. Okay.
Let's say you build and sell the power.
Okay, you build and sell.
Yes.
Okay. If you are to build and sell, I think it is easy to determine the lifespan of that project before major turnaround maintenance, before major equipment renewal takes place. That will be the lifespan. If the equipment have to be renewed, maybe after 10 years, okay, is it 50% of the, I mean, for me, there are ways to do this. You must establish the lifespan of a project. The other way to establish the lifespan of a project is also where are you getting the money from? When are you expected to pay back the money? So I've explained two ways to establish the lifespan of a project. The other lifespan could be, what is the lifespan of 80 to 70% of the major, if you are using a turbine, for instance, it's very easy, or a big pump, it's very easy to establish the lifespan of the pump. In most foreign countries, when you're building a dam, we don't expect a dam to last more than 50 years. We don't expect some roads to last more than 25 years. So these are different parameters to establish. So it is possible to do a mean weighted average of the individual lifespan of that project to come up with a single value. For instance, if you are building a turbine, a power station, the lifespan of your turbine is different from the lifespan of the dam. It's different from the lifespan of the electrical equipment. So most times you can take the lifespan of the least, but that might not be healthy. So the best way is to use a mean weighted average of the lifespan. But that is coming from me anyway. Also, your investors, your borrowers can also advise. Chartered Bank might tell you that we don't invest in a project that will not last more than 25 years, or that will last they can give you a fixed boundary. So that is how you can determine the lifespan of a project. Okay, let's go on because we still have more questions to solve. So I'll be a bit fast now.
Hello, Uche. I just want to come in based on the question that was asked. I also want to be clear. If maybe perhaps what you mean is maybe you have a project and you have components that has different lifespan, because in that case it becomes difficult for you to establish the net present value. I don't know if that's
yes, that was my question. Yeah.
Okay, so in that case, I think that's where annual worth comes in. So because they have different lifespan, you have to now disintegrate those. So if you're given a present value of that project, maybe for individual component, you know the present value. Okay, so that's where you now have to kind of split it into an annual worth. So you're looking for annuity or A given P. Okay, so you can now split them into individual years. So you can now use maybe the first year to compare, the project. I don't know if that explains it a little bit.
Yeah, I mean, if you do annuity, you can come up with the annual value of each of the individual equipment. But
Exactly.
how
So
about
you cannot compare it on that basis.
Yeah, but so I'm asking, how about the live? Let's say in a power plant, you have the turbines, and you may have, if it's combined cycle, you may have also the boilers, you may have pumps, you may have the balance of plants. Each of these has different lifespan. So how would you determine the lifespan of the plant itself? So are you using the most critical element, or the weakest, or the strongest, and all that to come up with the end in case you want to calculate, say, your annual value or the end of the project value?
Okay,
Something like
okay.
that, I'd like to know.
So if that's the case, the entire project you have, so it is a power plant, but of course the power plant has different components with a different lifespan, in which case you
Yes,
need to do replacement after some years, right?
correct, yeah.
Exactly. So you have to also factor that into your analysis. So after some certain years, you have to, it's also an annuity that's more like a sinking, the money that goes down, not a positive annuity, this is a negative annuity that goes in. So you have to also represent that in your cash flow diagram. So it's also an annuity. Maybe every 5 years, you spend this amount of money. I don't know if that's kind of explains it.
That's okay. Thank you. Yeah.
Okay, thank you, Engineer Chima. Thank you, Engineer Kaite.
Okay.
So let's look at this. Look at this question. I don't know what it's showing. Let's digest the question. A new lighting system will last 6 years. It will last 6 years. I think Engineer Kaite is interested in knowing how do you determine that 6. And as from what all of us have said, I think the lifespan of the most critical components should be used as a reference, while also assigning a particular amount of setting aside a particular amount of money annually for maintenance. A solar system lasts for a solar panel lasts for 25 years. So you cannot build a mini grid and say it will last for 50 years. It's not possible, because 60 to 70% of the components will come from solar panels. Are you getting me? So for the batteries that will be renewing every 2 years, you should incorporate that in your cash flow diagram. Do you understand it now? Okay.
Okay, it was
Yes. Are you
actually
hearing me?
from.
Hello?
Yes, you are hearing me.
I can hear you, sir.
Okay, it's all right. I'm following.
Okay, good. So a new lighting system will last 6 years, and it will save you 5,000 per year. The company purchasing it requires a hurdle rate of 15%. You can view this as a profit. The company that is purchasing requires a hurdle rate, or they are borrowing at 15%. In order to meet the company financial requirements, how much can they pay for the lighting system? Now, this is a very germane and a very common question. You go to one village in Akwa Ibom, sorry to Engineer Kaite, and you want to provide them with a solar system, and it will last for only after 5-6 years. It will pack up, and you've done your energy demand side management, and you find out that the community will be saving maybe $5 per house, and there are 1,000 houses. I'm giving you an idea how to do these things. What we know is that at the end of the year, the community in Orong is saving $5,000 or naira. The question now is, what will be the cost of that investment for those communities to accept it? Knowing fully well that inflation or Stanbic IBTC will borrow you money at 15%. So what is the minimum? Now we're looking for the minimum. What is the minimum amount that what is the maximum amount of money that the community will cough out in order to have this and make sure that nobody is cheating anybody? So let's go. So we're done with the first one. So let me put this one here. So the P is what we don't know. The P is question mark. Okay. The savings, which is the A, we know is what? 5,000, isn't it? The number of years is 6 years. And the interest is what? 15%. So the formula again is the same. All right. P is equal to A into what? P over A, comma, 15%, comma, 6 years. So can somebody go to the table now and look for me at table number 15% under 6 years?
Ooh, I'm not doing anyone. I wouldn't do anyone, man. Animal. This is what I don't anyone. If you have the table now.
So go to the table now and look for, this is the table for 20%. So let's go for 15%. Please, let's be together. Let me hear a response. If you're there, so just say yes or type yes. 15%, are you there? 15%.
Yes.
Yinachima.
Yes, I'm with you.
Okay, I'll tell you in advance. Is the weather is behaving funny? So anticipate my network to go off. If it goes, we just continue with the question, but let's continue.
Okay.
Okay, just be on standby. So now let's go, gentlemen. So for 6 years, what is the factor? Engineer Peter, are you there? Who again is there? Engineer Bolari. Engineer Bolari, I think you've been in our previous training.
3.784.
Okay, so the 3.784. Thank you. So it means the P is equal to 5,000 multiplied by 3.784. And what's that value?
920.
920 what?
Plus.
No, 920 what? Check again, sir. I don't think so.
You multiply both.
To give you what?
18,920.
15,920. Okay, 15,000.
No, not 15. 18,000. When you multiply $5,000 with the value
3.7.
the 3.78.
To give you what?
It's 18,920.
Oh, sorry, 18,920. So, gentlemen, it means that if this foreign company or the local company or international company comes with a proposal of more than $18,000 for this investment, then it's not worth it.
Okay.
Are we together?
Yes.
It means that the project cannot pay for itself. And that is a problem of many renewable energy investments in Nigeria now.
Okay.
That's the problem of many renewable energy investments in Nigeria now. Once you are not able to capture this, I can hear you, sir.
Yeah, sorry for drawing you back. I stepped out earlier. So can someone tell me how to read the table?
Okay.
How to get that value 3.7?
Okay, just hold on. Yinachima, let me adjust myself, please. Yinachima.
Yeah, Ushe.
I take over. Let me adjust myself.
Okay. I hope I'm not going to lose your screen. Hello.
Yeah.
Was it the kite that said he lost that he went out to catch up with something before?
No, it's Peter.
No, not like I did.
Okay. Okay, so what your question? You wanted to know how we arrive at 3.748, right?
Yes.
Do you have the interest table with you?
Yes, I have it.
So go to the part that has 15%.
15%.
Yeah, go to the table that has 15%. Then go down to number 6.
And that's page 22. Page 22.
Page 22.
Yes.
Percent on
Have you seen it?
Savings.
It's okay.
Have to save each
but I see you so just table. Yeah, okay.
Hello, Peter.
Yes.
I need to know if you've seen it.
Yeah, my system is a little bit slow.
Okay.
Well,
Sorry.
But we
Hold on.
can continue. Maybe I don't know, so that we don't take
I'm
much
back.
time doing it.
I'm back. Engineer Peter.
Yes, you said page what? Page 22.
Yes, at 15%. Each interest table has a percentage table. It's one particular percentage. So when you get to the interest table, you now look for the number of years. In this case, it's 6 years. And we are looking for the present worth. You know, these investors came and they told us how much we are going to be saving in our energy projects. They told us how many years it will last. And they told us their profit margin. So our job is to find out what is the present value of that investment.
Okay, I've seen it. Okay,
15%.
So here,
Then
6 years. So here.
Okay. Okay.
We are looking for the present worth. The present worth of what? The present worth of what? Something is echoing.
Present 4 point. 3.784.
Question number 2, yes. Question number 2, yes.
Clearer.
The lighting system will last 6 years. It will save 5,000 per year, and the interest rate is 15%. So at the end of the day, this is what we got. We got 18,920. So that means the investors, the proposal they are bringing must not be more than $18,920. So if a company comes now with a proposal of more than this, then it means the project is not sustainable. It means the project cannot pay for itself. It means that project must be rejected. So even we ourselves now should be looking for a project that will be far less, that will give a margin of safety to our own investments. So that is that. So let's go to the next question. We don't have time. Gentlemen, what we'll do is we'll just skim through the whole question. Then subsequently, when you watch the video, and of course, I guess this thing is recorded. When you watch the video, and by tomorrow too, Chima will hit 1 or 2 places also. But the whole calculation should be done by today. And we'll have barely 30 minutes or 40 minutes because of the late start to do. So question number 3. So let's go to question number 3. Any question? Is it understood? So this is question number 3. This is for people who want to, what do you call it? Do energy saving. So you say a boiler economizer. Somebody will be wondering what is a boiler economizer? Well, is an equipment that is attached to a boiler that will help reduce energy. That will help in energy reduction.
We are not seeing that.
Okay. You're right. You can see it now. So this is question number 3, or scenario number 3. I will call them scenario in the next course. next quarter. So a boiler economizer will save 20,000 and last 5 years. How much will the economizer have to save each year to return 12%? Are we getting it? This is equivalent to the other question, but the difference now is that to install this machine, it will cost us $20,000, and after 5 years, it will need replacement, or after 5 years, it will die, or it will be unusable, or it will be unserviceable, or after 5 years, they will take it back, whatever. Now, the question is, how much do we need to be saving in our energy costs? How much will the company be saving due to the installation of this boiler if the prevailing interest rate is 12%, or if the company that they're installing this thing for wants to make a profit of 12%? You see, this percentage can come. That's why, listen to me, gentlemen, banks make their profits from percentage, from interest. There's no nothing they do. You put your money in the bank, they loan it out to somebody, collect interest. They collect money from CBN at 11.5%, and they loan it to you at 15%. They collect 4% to pay for their MD, pay for their staff, and buy their BB cars, and maybe build a new headquarters. That's all they do. So as a company too, you yourself can also establish your own interest rates. Like for me, for instance, if I'm going to go into procurement, if I don't see 30% profit margin in any project, I don't do. Companies like Julius Berger, if they don't see 50%, they will not do. Because they know that by the time they pay bribe, do this, do that, they will come down to 30%. But for me, I have fewer people to give money to. Highest desk officers, which will not cost me more than 2, 3, 4, 5%. Okay? Even though the thing is going up by the day in Nigeria. So that is the question. So I want us to understand this. So let's solve it. So what we're going to do is we are given P. We're going to look for A. We are given P. We're going to look for A. So let me go to my screen very fast. I'll be fast about this one. So P is what? 20,000. A is unknown.
That's the savings.
The savings. We don't know what the savings. We don't know the savings.
Yes.
It will be given us. Then N is what? How many years?
5 years.
5 years. Thank you. And the I is what?
12%.
I feel like emphasizing on this I. This I can also be your profit interest, your profit ratio. It can also be the banking loan. It can also be the own company's minimum attractive rate of return. Then if it's a social project, that I can be the IIR, internal rate of return. It means there's no profit coming to the bank, there's no loss, because the bank is running charity. I know there's no bank that does that anyway. Okay, so now we are looking for A, and we are giving P at A over P. That's the factor in our interest table. Okay, at 12% for 5 years. So can somebody go to the interest table for 12% under 5 years?
0.2.
Under A over P. Be careful, sir. Be careful, sir. You are going to go to A over P. Remember?
Yes.
We're doing capital recovery now.
0.2774.
Okay, I'm 15%. I'm happy we are following. I'm happy we are following. I'm happy we are following. I'm very impressed. That's impressive. So 0.2774. Thank you. I'm impressed. So it means that the annual savings for this investment will be 20,000 multiplied by 0.2774. And what is that value?
$5,548.
Good. Now, do you know what this value means now? This value means that I will go back to my company or to my consultant and I will do my energy savings analysis. If we are not going to be saving 5,548 every year, then don't install that system for me. It means that system is not worth installing. If I cannot save this amount of money per annum, it means I cannot break even at 12%. It means that project is not self-sustainable. It means that if I embark on that project, it's either the community. So this value now is telling you that this project, this is what you must make. So I cannot decide to set a target for myself by saying that I will multiply this value by 20%. Please don't get confused, sir. I can multiply this value by 20%. You know what I mean? Which is multiplied by 1.2. Okay? And if I multiply by 1.2, it means this is now what me I'll be targeting, so that I know that I'm also getting 20%, because this is the benchmark. This is the baseline. This is the baseline energy we need to save to be able to recoup our money. So if I now multiply by 1.2, which we always do in engineering, I'll be getting something like 6624. Please, the question didn't ask me this one. The question stops here. I'm the one just trying to digress to show you other scenario as a businessman, what you should do. Any question before we go to the next? So tomorrow, what Engineer Chima will teach us now is how do you calculate all this? How do you generate this 5,400 by estimating for solar and lighting points, heating points, refrigeration, or you focus on the key energy intensity areas? Sorry for those who didn't come for the two previous trainings. I think Gina Peter, Bolari, and who again? I don't know who else is around that came for the previous training. We all thought of all discussed about this in our previous training on energy efficiency and energy auditing. Okay, so the next question now. If there's no question, move to the next. Okay, here's the next question. Now, the next question says that you are an energy expert. You are an energy expert. You've undergone this training and you've boasted about it. I've issued certificates.
We can't see your screen.
Okay.
I mean the question. We can see the whiteboard, not the question.
Okay, this is the next question. A company has asked you to look at two projects as an energy expert. Each project will last 8 years. The first project will cost $125,000 and will save $33,000 each year. The second project will cost $153,000 and will save $46,000 each year. The company has a discount rate of 12%. Which project would you recommend? In one of my slides, I said if you are the lender, you use discount rates. If you are the borrower, you use finance rate. I can't remember again, but I know I mentioned it somewhere. So whatever rate they mean, all we know is that it's interest. Is that interest you are paying as a businessman, as a loaner, or the interest you are, is that the interest they are paying you or the interest you are paying? It can also be an interest that you have built in your profit inside, or you have built in other risk. After all, money is all about risk. So we're going to solve this question. So what this question needs from us is for us to understand that you are solving two questions. You are solving two projects. These are two independent projects. One proposal is coming from Siemens The second proposal is coming from ABB. One from Germany, the other one from France, from Switzerland. So the question now is, which one will you accept as the energy expert, as the energy engineer that have paid and you attended this training? So you need to solve it. So let's see how we're going to solve it. Remember what I said? We're going to solve them independently because this is a comparison. This is an investment appraisal. You are going to solve it to make an investment decision or to recommend based on their financial outlook, not based on social or environmental consideration. The focus is on money, and money is everything, of course. So the first project, please be looking at it now. Let me go to my whiteboard.
Yes.
I'm going to clean some of these things, please. Good. The videos are there. I'm cleaning them. I hope we're okay. Are we okay with me cleaning them? Hello, gentlemen.
Yes.
Or you
Yes.
can snap your screen. Can you go to your screen and say snap screen? Try it. Press, there's a key in your computer called print screen. And there's a key called FM. Depending on the kind of computer you have. It's either you hold the 2 key, you print it. My own, I have to hold the 2 keys. So if I print it now, you go to any Word document or you type, or you come here, you type paint. When you type paint, you open paint. Paint will open. When paint opens like this, you press Ctrl V or you say paste, or you go here and say paste. This thing will snap. Are you seeing it? I'll snap my screen. I will now come here and I'll save it on my desktop so that later on I can review it. Save image. Or you save it in the same folder. So I can go to my desktop and I will say day one calculation. So before I clean it, I would like you to print screen. If you see anything on your computer that you like, or a picture of somebody, just press on print. For some computers, you just have to press print screen. While for others, you have to hold the function key and press print screen on your keyboard. Okay, so let's continue. Just print the screen. You can paste it later. You can even paste it in Word. You can open Word document and paste it. So if I open Word document, I can also paste it there. So I'm cleaning them now. So the new question now. Hold on, please.
Present factor. Present.
I can't find my. Sorry, I'm having an issue. I can't find my tools. Okay, let me stop to share. Okay, it's back. So now project one. Project one from Siemens. Siemens proposal. So what's the present what's the investment? Yunachim, are you there? Okay, I need somebody to just help me call them out so that we can be faster. So what's the present what?
125.
125, thank you. So that I'll be sure we understand. We're getting it. Okay. And what's the savings? Annual savings.
Annual savings is
33,000.
33.
How many years will it last?
8
years.
What's the interest rates?
12%.
Senator,
12%.
how you there?
Okay.
Hey, good evening. You there break?
So project 2 from ABB. Okay. And what's the P?
153,000.
And what's the annual savings?
46,000.
You know that this annual savings, you must have done your calculation, your downstream calculation. You must have calculated different factors. You must have subtracted different factors. Even this, you must have added the money you are generating, the money you are paying your staff, the money you are paying your security man who is guiding the generator plant, the power plant, the money you are paying, as you must have come up with the net. So this A is your net income. Even you must have factored in your risk. So this 46,000 is what you are sure of. In fact, maybe you are expecting 50,000 every year, but you deliberately reduce it by a factor of say 10 or 15% just to be on the safe side. Okay. Number of years, 8 years. What's the banking? What's the interest? Or the profit? How much? 12 here. Okay, so let's go back to project 1. So here, as usual, we are looking for what? We're looking for the principal of the savings, isn't it? Are we together? The principal, we're looking for we are looking, we're looking for the principal on the savings, which is P equals A in brackets, P over A, comma, 12%, comma, 8 years. Are we together? So the P is what now? The savings is 33,000. So can somebody go to the table of 12% under 8 years? What do we have?
Yes. P over N.
4.968.
Okay. I hope you're sure. 4.968.
That's
okay.
correct.
Somebody should confirm. Okay, good. So that will be equal to what? Somebody help us again.
$163,944.
So it means that this savings we are getting from this investment of 125,000.
We have not. Okay.
Yeah, no, let's finish with this one. The present what is now, as we said, the P on savings. I don't know how to put small letter underscore, please.
Yeah.
The P on savings
minus
the initial cost.
P of cost.
P of cost. And what would that be? 163,944 minus 125 0,000. And what would that be? If this thing will ever give you negative, run away from the investment.
38,944.
So this is the net present worth of it. But you all know that this is it good or bad?
It's good.
It's good. But
it's good because it's positive.
It's positive and it's also much.
Yes.
But you don't know, but then you have 2 proposals. So let's go to the second proposal. It is when we finish the second proposal, we know which one is higher, isn't it?
Yes.
We now choose among those alternatives. So let's quickly do what we did here now, and let's be fast about it. Somebody be on your calculator already. You should be on your calculator by now because we don't have time. Equal to A into the same thing, I guess, isn't it? P over A, comma, 12%, 8 years. Okay, and that will be what? 46,000 multiplied by
4.968.
4.968. And what would that give us, please?
228,528.
Hence, the net present value of this now will be what?
So 153.
I don't need to write P cost minus PK saving again.
That's 75,528.
75,528.
That is 228,
528 minus 153
53
000.
So the two projects are all good projects because their MPV is what? Positive.
Positive.
It means the project will fly. It means the project is sustainable. It means the project is viable at 12%. It means the project is bankable. It means the project is investable. It means the project is some grammar that I don't know how to speak. But the thing is that the project is good. And what is that amount?
75,528.
528. So which project is good now?
The second project.
God bless you. So I'll tell Siemens to back off. And I will accept the project from APB. Project 2 is a better. So you can snap screen again. Oh, sorry, why are you even snap screen? The solutions are in the manual already. Maybe solved differently because most of these questions I'm solving, there are at least two ways to solve them. It's either you solve them based on their present words, you solve them based on their future words. You can also solve them based on their annual words. It's just that some solutions are more difficult. And being that we're in a training, I will show you one method because we have this is Zoom training. We have maximum of 3 hours. But when you go back, I want you to try to use other methods to solve it. And some of the methods are also in the slide. You can solve this question too by saying, what is the net amount this project is bringing in? Are you with me? Gentlemen, are you with me?
Yes.
So I'll only solve one with that method, just to buttress my point, but I'll never solve again. So for this first project, if I didn't use this method to solve it, I can also say that method 2, another way to solve it is by saying we have our A. Our A is what? 33,000. What is the A of P? What is the annuity? I will annuitize P. So I don't know. No, let me put it this way. No. Okay, no. Wait. No, I'm looking. No, sorry. Sorry. In this case now, I want to know the annual income of this project. The project is costing us 125. I hope I'm not going to confuse you with this. We have finished the question. We have finished solving it. But I want to digress. I want to show you how you can also use another method to solve it. So the question now will be, what is the annual? What is the equivalent annual amount of this P?
Cost.
In brackets. What is the A over P? Before we are talking about P over A. Now I'm talking about A over P at 12% at 8 years. Okay, so I'll go to the table. Now, A will now be 125,000 multiply, sorry, this is the best one to use for multiplying. Multiply by, so under 12%, can somebody help me under 12%? At find A given P. To find A given P under 12%. To find A given P. Let me use capital recovery method. Capital recovery method.
Yes. How many years?
8 years, sir. 8 years.
8 years?
Yes, it's the same number of years, sir.
So that's 0.2013.
0.13. Thank you, sir. So I will now come here.
Okay, 0.2013, yeah.
I'm using the capital recovery method now, just to show you that we do the same thing. So 0.2013. And what is that value, sir? $0.2013 multiplied by 125,000 is giving me 25,163. Do you know what this means, sir? This thing means that if I make this investment of 125,000, that the annual cost of this investment is 25,163. And what is the annual savings? 33,000. Therefore, the net savings will now be 33,000 minus 25,163. Do you understand it?
Yes.
So that will give me an amount of money that is the net savings per annum, not per project cycle. It means this is, we are saving 7,837 every year. So that is the savings the proposal from Siemens will be giving me. Now, how about the proposal from ABB? Let's see. So method 2 for ABB now. The same thing applies. We're looking for A, isn't it? But this time, the proposal from ABB says $153,000. Okay, same number of years, same number of everything. Therefore, A will be P, okay, into A over P, comma, 12%, comma, 8. Therefore, A will be what? 153 multiplied by 0.2013. Am I right?
They give you 30,798.9.
8. Let's call it 99. And what is the savings? The savings is what? $46,000 per annum minus 30,799. That will give me.
That's 15,201.
A project that will give you a net savings of 15,000 and a project that will give you a net savings of 8,000. Which one will you choose?
The second one, of course.
Okay, so you can see. Now, if time, admin time will permit me, admin were in a physical classroom, I will have also shown you how you can also use the future method, whereby I will reference both projects to the future. I will project them into the future. And so, and say, after 8 years, how much will we have made? All things being equal. I can also use it to evaluate the investability of this project, the bankability of this project, or the viability of this project. So I'm going to clean again. If you want to
wait,
snap,
before you
I have a question.
Before you clean. Okay, go ahead with your question.
Okay, so my question is that, so we were already given an annual saving of 33,000 in the case of the first project. And then when you now use the initial cost to calculate, we now arrived at 25,163. So why, I mean, why are there two different savings, if you understand what I mean?
This is per annum, per year.
Yes.
This one is
Which is sorry,
for
I
the
think
present.
the second A is not savings. It's actually the cost that you split it into annual cost. So
exactly, that's what I think.
That
Yes.
that 25,163 is the cost of that project, but you've split it into an annual cost. Yeah, exactly.
That's what we
so it's
say.
not
We're saying the same thing. Okay, is it like saying savings? I didn't say savings.
No, you said savings. So you said A here. And when I looked at the question, the 33,000 is also annual savings.
Okay, no, this is savings. But
Yes.
the A here, okay, I understand what you said. Okay, I use the word interchangeably. The second
method,
A
that
here
A
is the annualized cost of investment. We are looking for the annualized. I don't know.
Okay, so what?
That's the word. So it means that.
No, I think he understands this now.
Okay.
So, but what I wanted to add is this second method that Uche used is also very suitable when you have project with two different durations. So if project A has 8 years and project B, the ABB has 10 years, you're going the method 1 will not work for this solution. So you use method 2. And this is what I was trying to say when I think when someone asked the question, and I was trying to explain that what you have to do is that the cost, you have to annuitize it. You have to break down that cost into an annual cost, so you can be able to do this kind of subtraction.
Yes.
So it's most suitable where you have project with two different durations. You cannot use method 1 if you have two different durations. You can only use method 2. I just wanted to add that.
All right.
Another
but
thing
in this case,
let me also put this question.
This is Ephraim.
Ephraim, sorry. It also gives you how do I put it this way? It gives you, maybe if the project is a project that we don't know the end lifespan, we don't know the end, we don't know how it will turn out after many years. So our interest will be, what is the annual cost? What is the annual investment? So at the end of the year, it calls shareholders together and share the money. Any day the project stops, everybody go home. I don't even understand.
Okay. Yeah. I understand. And I think that clarifies the question I asked earlier. So we know the annual cost. Maybe you can just decide to fix the life of the project, which you think will be profitable, for the business.
Yeah.
Okay.
And if other factors have been factored in, this annual cost might be depreciating as the year goes on. I don't even understand.
Yeah.
Good. Okay. And what Chima just said now.
If the second A is annual cost, the other one is what? Overall cost?
No, this one, what we did here. Okay, let me explain again what we did. And let me explain, going back to the question. Very important that we explain this. Now, is it this one? Okay. Now, for the projects, we use two methods. Number one is to say we're investing 125 and we are saving 33,000. We're now saying, what is the worth of this savings to the present? In the second case, we are saying, what is the annual cost of this investment, this 125,000? What would be the annual cost? And that annual cost is what we got as 25,163. In other words, it's either you give me 125,000 to invest today, or you split it into 25,000 every year for the next 8 years. They are the same thing. Did you understand it? It's either you give me 25,000 to do investment now, or you give me 20.
No, 125,000 is the project cost. Hello?
Network.
Which are you still there?
This question have two different lifespan. We can also use the two methods to solve it. He said that a company considers two projects. The first project costs 85,000. and will save 23,000 each year. The second project costs 75,000 and will save 18,000 each year. Project 1 will last 12 years and project 2 will last 9 years.
Sure, we're not seeing the question you're reading. We are still seeing your whiteboard. We're not seeing your question.
Okay. I hope we'll all open the slides. So this is the question. There are two different questions. The difference between this question and the first one is that this one have two different lifespan. One will last for 12 years. The other one will last for 9 years. So if you do MPV based on 12 years and compare it to MPV based on 9 years, you might not be right. But if you annotize it, well, you're going to get the same result anyway, because why you're going to get the same result is that you are bringing it to the same reference level. So which project will you recommend? Can I have a suggestion? Any suggestion?
So we need to do the calculation.
Okay, so the method we use for this one will be to use what is the annual watts per year, just like Chima said. That will be the most appropriate. Now look at why you might not, this is the most appropriate. The two projects have different lifespan. So a project that will last for 12 years and a project that will last for 9 years, if you bring them to the same present value, one, there will be a kind of a small error. It might not give you the exact picture of what is happening. But if you now annuitize it and said, oh, wait a minute, how much am I making per year? Whether I'm investing for 12 years, I'm investing for 9 years. I'm just a businessman. And I just want to know, because my bank is giving me, is charging me per year, or my lender is giving me money per year, how much am I making per year? So let's solve quickly. Let me clean the table, and that will be the last for today. And then we'll ask questions and we answer them. That will be the last question. Tomorrow we'll delve into how we generate some of these, how we come about, how we're going to measure your square areas, how your user a lot of economic indices to calculate energy savings. Okay, so let's start. So the first project. So somebody help me. So what is the present value? What's the P?
85,000.
That's the initial investment. What's the savings?
23,000.
Good. This savings is inflow. If we do this is inflow savings. There's also outflow cost. 23,000. This is inflow savings that's coming in. Okay. Interest is what?
10%.
Number of years?
12%. 12 years.
12 years. So we are using the annual watt method. Are we together? You know, I've already said all these things in my beginning. We use the annual watts, or we are going to annuitize it. I'm an investment banker. I'm not interested in long-term investment. I will just want to know how much is coming per year. So we say that
All right.
the MPV is what? Savings minus what? Cost. So we're going to say, put it this way: annual savings minus annuitized cost. So the annual savings is given. Annual cost, we don't know. So let's look for the annual cost. So the annual cost is A equals P into A over P, comma I, which is comma 12, no, comma 10, comma 12. So can somebody help me with interest table? Go to 10%. Interest table, go to 10%. So now we are looking for the annual cost of the initial investment, which is 85,000. So what did you get at the interest table?
Percent.
10%.
6.145.
Sorry?
6.145.
No, sir.
That's 0.1468.
Thank you. Sir,
Yeah, 0.1468.
yes. Did you understand, sir? The other one, yes, that's a very good one. It's a good observation. So we are doing capital recovery. We are trying to recover and annuitize the capital. We're trying to recover capital recovery. Yeah. Did you understand this, sir? 1468. 1468.
Okay.
Are you okay? Do you got it, sir?
Yes, yes. No.
Okay. 0.1468. And what's that value? So what you are getting now is what they call annual cost of capital. Annual cost of capital, or the annuitized cost. It's like I'm living in a house. I pay 1.2 million in a year. My monthly payment is not 120,000. It's not like that. It's about less than that. Are we getting something, sir? If somebody is paying me 365,000 in a year, my daily payment is 1,000 naira. That's it. So delitized, if there's any word like that, is 1,000. Annuitized is 365,000. That will be at zero interest rate anyway. So what did you get, sir?
12,478.
12,478. What this means is that if I decide to invest 85,000 now, and I decide to be investing 12,478 every year, they are the same thing.
Okay.
That's what it means. So
right.
this arrangement comes in when an investor is coming to invest and you don't have money to pay him one-off. You decide to pay yearly. You now annuitize it. So now the net savings now will now be 23,000, which is the annual worth savings minus the annual worth cost. And that will be what? It means the project is viable because the NPV of the cost, the net present value, if there's anything like that, is positive. It means that the next savings is positive.
$10,522.
Are we together?
Yes.
I'm trying to see if I can copy this, the whole of this, and just do for project 2. And so here is what? What's the project 2 is what? What's the initial investment cost?
$75,000.
And what's the annual savings or income?
18,000.
18,000. Thank you. So that's the annual income. This is after all losses. After this is the net of what is giving me. But then I need to know the annual cost of that investment. So the annual cost of investment will now be 75,000 multiplied by what? 0.1468. That will be 11,010. So it's either I invest 75,000 one-off, or I will be investing 11,010 naira for 9 years at interest rate of 10%. They are all the same thing. Therefore, the net is now 18,000 minus 11,000. And that will be what? $6,990. So which project is better?
Sorry, Chima, the life of the project is not the same. So this one is 9 years.
Thank you. Okay, so what's the value? What's the factor? Thank you so much.
So the factor should be,
that's a good observation.
The 0.1736.
Points. 1736. Yeah, it's 9 years. And there was it here. 736 multiplied by 75. 13,000. Therefore, the net savings.
18,000, yes.
Yeah, minus 13.
The 4,000 something.
So do you prefer a project that is giving you 4,980, or do you prefer a project that is giving you 10,500 per year? Are we okay? Are we okay with this?
Of course, we prefer the first one.
Okay.
The one that gives 10,522.
Thank you. Thank you. So, now we're going to continue tomorrow. Tomorrow, Ajachim, are you there?
Yes, I'm here. I mean, let's just go ahead with the question section. I mean, we'll sort out how we proceed tomorrow. If maybe you continue, or if I'm coming in tomorrow.
Okay.
So let's just.
So let me get. Okay, good, gentlemen. This is where we're going to, and this is 6 o'clock. Let me not stress us and overpromise us, but let me get feedback from us. Any questions so far on what we've had today? Any question?
Yes, I have a question.
Okay.
So the last example you have given, so we basically calculated the annuitized initial investment where we arrive at certain figures for each of the projects. And they are less than the annual saving, basically. So my question would be, so what did each of the projects do such that the savings are more than the annuitized initial investment? Because that figure we arrive is what I might call maybe the break-even points, what we calculated, the annuitized initial cost, more or less. So what did they do, to have the annual saving that is more than the annuitized one?
Well, that is what the energy auditor is the work of the energy auditor now, to look at the areas where the company or the firm can save money and then to monetize it appropriately. So this savings now, at this point, we might not say precisely what they have done to save this, but suffice it to say that they must have captured what this 85,000, maybe this, let me say for instance, in a household, this 85,000 now will involve changing the AC from window units to a more saving energy unit. Some of these new ACs now. It would have captured replacing the moribund plasma TV into LEDs or even HLED, as they want us to believe now, high definition LED now. It must have taken into account the refrigerator that they've been using for 10 years that consumes up to 500 kilowatts to a newer model that will cost less than, I think some now cost about 80, from 500 to 80. Then all the heating equipment in the house might have been replaced with maybe gas. And then there are other energy saving measures which is beyond the scope of this course. I think we dealt with them in the first training we did on this certified energy auditing series, and that is energy efficiency and energy auditing. That was the first training we did. That was in March this year. So in that energy savings training, which I will oblige us to send us the video, YouTube, so that you can watch it, you will see how you can save energy in every way. So though that is the work of an energy auditor, but with common sense and as engineers we are, it is easy to know where to save energy in your home with little or small training. It's very easy. So it is that investment, like in one of the questions we solved, they talked about economizer. Economizer is something you attach to a boiler that will help to reduce energy costs, that will help to reduce energy consumption, either by recycling the wastewater or by using some kind of exhaust system to heat the boiler. There are many things going on in the energy world today, and that is how they were able to save that 23,000 naira. So the final way they get that 23,000 naira is that when you get all these energy savings, all this area you're going to save energy, you calculate the kilowatts you are saving. From the kilowatts, you multiply it with the prevailing electricity rates, then you get an amount. So when you now aggregate the amount from day to month, from day to annual, you can now get this 23,000. So right. It's just a way of like going back to the first training we did. And that is why we program this training to fall into 3 segments. We'll start with the basics, the intermediates, which is renewable energy and solar PV design. And then finally, we're ending with now costs. So after generating these costs, how do you now put it on paper or put it into an investable templates. How, because this what we are doing here is what the investor wants to see. They don't want to see how you are going to change, what kind of LED you're going to change, when you're going to buy, what are those LED in the market? When you're going to buy change your AC, you're going to change your heating system. You're going to be reducing the temperature of it. No, they're not interested. But what is the final amount, but justifiable? I don't know if that answers your question, sir.
Yeah, it does. Thank you.
So maybe I don't know. I will before the end of the class, I will show you some of our videos on YouTube. You can watch some of them so that you see what we did in the first class if you have the time. Any other question?
Well, maybe just a comment. So I
ahead.
tried to reach you. This is Ephraim. I tried to reach you with the number you get to me. I called, but you didn't answer. Do you have another number I can reach out to you, Che? And maybe the same
No,
for
sir.
Chima as well.
This is the only number I use. Actually, me and my friend, we are running a training this week, a physical training in Abuja. So most times when you call me, maybe my phone will be on vibration. I'm sorry for that.
Yeah.
I'm sorry. It will end by Friday tomorrow. So I'll be free once again.
Okay. Chima, can I have your number as well?
Chima, you can type your number on the chat box. So most times if you chat me up on WhatsApp, I always respond because then I'm not talking with my phone.
Okay.
So for the other participants in the class, please, tomorrow, me and Chima will discuss 2 options we have. Either Chima comes in tomorrow or we'll continue and exhaust this. Now, let me give you the secrets. And this is practical. One of my friends is doing a training for NNPC staff this week. They are going to write an exam called Certified Course Professional. And guess what? Most of what you are learning in this training are all curriculum of that course. That course is like PMP. It is organized by Association for the Advancement of Cost Engineering, USA. So most of what you see here, these are something you're going to meet in your MBA class. I'm speaking the truth. These are some of the things you're going to meet if you're writing PMP. These are one of the things you're going to meet if you're writing Certified Course Professionals. And then the big one, the biggest one, if you plan to write CEM, Certified Energy Manager exam, you want to get certification as a certified energy manager, or you want to get certification as a certified energy auditor. These are compulsory questions. In fact, they constitute up to 20% of the questions you write in that exam. So all the people that are coming for our training, I want them to take this seriously. You're going to meet this in life. So by tomorrow, hopefully, we're going to continue with the remaining questions so that we can examine wide range of scenarios and questions. And then after that, I will show you how to use Excel to do other costing. I'll introduce you on how to use Excel, the financial tools in Excel. Then on Saturday, Chima will take you through module 7. I've already sent it to us. So you can go ahead and read ahead of Chima. But then the calculations might be difficult for you. When he comes on Saturday, he will dissect, or tomorrow, he will dissect the whole question. So there's a whole lot. So in a nutshell, this training has to do with mathematics and calculation. But we're going to make it so simple, so easy, and so friendly so that we'll grasp everything. And as I said, at any point you are lost, just call me back. And for today, we did a good job. So if peradventure we leave this class now and you have a question, please chat me up or chat Chima up. Chat me up or chat Chima up and we'll respond to you. Very, very important. And if peradventure you have a scenario question tomorrow, I want to encourage you, bring it to the class. If there's any current project you're embarking on in your company, in your firm, or you saw somewhere that has to do with what you are doing in terms of this financial analysis or energy investment in energy, please come with it. No matter how difficult it is, we're going to solve it together. So on that note, I'm going to bring the class to an end. This is almost 6:30. We just 15 minutes more. So tomorrow we'll continue by 3 p.m. and you can try some of the questions ahead of me if you have the time. But if you don't have the time, we're going to solve more of them tomorrow. So I don't know if there's any question. There are more questions and they are very interesting. Any question? Any other question? Yeah, I think we should continue with the questions tomorrow so that we know that we have effectively dealt with any mathematical question you can meet in any of your certification exam that has to do with financial analysis. This is all how they are. They can come in different shades. They can come with different grammars. They can come with manufacturing terms. We are focused on energy terms because we're dealing with energy, but they can twist it into manufacturing terms, outputs, inputs, and what have you. They are all the same thing. Once you understand the concepts, the basics, the methodology of solving them, and how to rephrase them, you are good to go. So, any feedback? Chima, do you have anything to say?
I think it's been an interesting one. I encourage our participants to always ask questions if they at any point they feel they're lost. Well, I mean, so far so good. I mean, it's been very interesting one today. Let us try to be on time tomorrow so that we don't have to spill over our stipulated time. I think that's all I have to say.
Okay. So, gentlemen, on that note, let me just thank every one of us for coming. I hope you have had your time, and I hope that the time is worth your money. Let's us meet tomorrow again by 3 p.m. Then last line, please, if you have not made payments, please, I'll encourage you to chat me up or just make the payments. Thank you. Thank you so much.
All right, Mr. Bao, thank you.
All right.
Thank you.
It's been a worthwhile training.
Yeah, thank you, sir. Please review the slides. Review the slide ahead of tomorrow so that we'll be on the same page. Very important. Just scan through them.
All right.
Thank you very much.
All right. Thank you, everyone. Enjoy the rest of the
you.
evening.
Yeah.
Thank you.
Thank you, Engineer Chima. Thank you, Engineer Uche.
Thank you so much. The pleasure is ours.